So let's try and bring all of this together, and summarize. We said earlier we think it's fall, but it's inevitable that winter is coming. We just don't know how bad the winter is going to be. Now, if we were a gardener, we'd buy a copy of the old Farmer's Almanac. And you can see, the Farmer's Almanac. This chart, this map was what it was forecasting for this past winter. But, point of interest, did you know that there is another Farmer's Almanac that was actually put out 20 or so years later and by a different organization? Last year, their forecast, and usually they're both the same, but last year it was considerably different. So we don't have the benefit of getting an almanac to tell us our forecast, so we made our own. We believe that it's fall, getting closer to winter, as we were saying. We don't believe you're going to have a recession this year. We think earnings growth in the economy are going to continue to grow, just not as fast as what we saw last year, but they still will grow. We think the Fed continues to tighten next year. We think they should. We think this could create a recession in 2020, maybe 2021, maybe 2022, but I think that starts to get pushing it a bit. We think in this environment, it's actually a very good environment for stocks versus bonds because of higher interest rates. We remember 1985 and 95 as examples of that. We think, though, because it's fall, you have to start thinking about reducing risk. Now, one of the things that we'd highlight when we talk about reducing risk, it's avoiding the temptation to move up the risk curve as you start to see more euphoria in the market. And I think that's one of the key things you have to focus on as an investor. There's also other things we're doing to become more defensive within our portfolios, and John's going to talk about this more, I think the best thing you can do in a portfolio is diversification, and it's a good risk mitigator. Overall, though, in this environment, again, to use a gardener term, we think the roots are very strong. One of the things our marketing department just did is we've rebranded. We're now known, instead of Nicola Wealth Management, we're known as Nicola Wealth, short and sweet. And now that's a subtle change, but what it enabled us to do was come out with another forecast. So this is the new Nicola Wealth Management forecast. And in this forecast, we're saying the Federal Reserve makes the mistake of keeping rates low for too long. And this leads to either an asset bubble or stagflation. We think in this environment, all asset classes are under pressure. And the concern would be if this happens at the same time as we have this inconvenient truth and higher debt, it could be a very severe reaction in the market. And you need to start putting in your diversified portfolio some asset classes that are going to help mitigate the risk of this happening. Because in this environment, we worry that the roots might get severed. Now, this isn't our base scenario, but we do think it's something we have to keep our eye on, but this isn't what we hope is going to happen. We think it's the old Nicola Wealth forecast. And the key, again, coming back to the strong roots. And that's one of the things we try and do in all of our portfolios as we try and help build those strong roots. And with that, I'm going to pass it over to John Nicola to talk about some of the strong roots we're building.